Hello, my name's Cam McWilliams and I'm the Business Reform Leader from Chartered Accountants Australia and New Zealand. And as we continue to discuss non-financial risks, I'd like to welcome Pru Bennett, Chartered Accountant and Partner of the Brunswick Group. Welcome, Pru.
Thanks, Karen.
Now, Pru, your experience has been quite predominantly in the space around investors. So when it comes to the types of information that businesses are disclosing, how are investors changing the game?
Well, I think when you look in the past, the reporting focus has been on sort of financial and physical assets, non-financial liabilities. And investors are increasingly taking a more holistic view at what companies are disclosing and how to value companies. And one of the big influences on that is what makes up the value of a listed company. And there's some research that's been around for a while, and it's only just been updated by Ocean Tomo, that shows that in 1975, 85% of the market cap of an S&P 500 company was actually tangible assets. In 2020, that's now down to 10%. So you've got 90% of companies, the value is actually intangible. So it's not physical assets and it's not financial assets. It's the other four capitals, which are human capital, which takes up a huge component of the value of any company, environmental capital, social capital, and intellectual capital. So if investors are looking at the value of a company and what's going to drive, or where the value creation will come from, or where there's risks of value destruction, they need more information about what's driving the intangible value of the company, not just the physical and financial assets. And also when, in particular, non-financial risk, as was identified in the Institute's paper, is not managed well, for example, a cyber risk, there is huge financial implications of that where non-financial risks aren't managed. So what investors are after is for companies to identify the processes that they have in place to identify material non-financial risk, and then how are those risks managed, and they're looking for reporting of data so that they've got some evidence that those types of risks are acknowledged by the board, and also that process around the management of those risks is quite clear and transparent. Investors are also focused on how a company makes its returns, not just on the returns themselves. And they are focused particularly when companies have negative externalities that actually don't appear in the profit and loss statement per se, and to make sure that there is a focus on minimising those externalities, and to make sure that those risks associated with those externalities are managed well. Because again, if they're not, they will come up as a line item in the P&L and impact investor value.
So why are non-financial risk considerations important?
Non-financial risks are very important to investors, and they have to be clear about what those risks are as identified by the board and the risk committee, and how those risks are being managed. As I said before, a huge component of the value of a company is intangible. And one factor that is often overlooked by companies in reporting is the value of human capital. And in Australia, where you've got an economy that's dominated by financial services company, the key asset for those companies are its human capital. So how is that being managed, and how is that being reported to investors? Other types of non-financial risk would be data breaches. So what processes are in place for data breaches in a particular organisation? Is it a material risk? How do they determine their material risks? Data breaches can have significant impact on the value of a company. There's compulsory reporting, and share value can plummet overnight if it's a major breach. So it's about managing the risk. It's also about having a backup plan that when things do go wrong, there is a process that can be reverted to around communication. Communication around these issues is extremely important, and also can be a litmus test as to the quality of management when things do go wrong.
Excellent. And we know that there's been a bit of a focus from regulators around non-financial risks more recently. What are your thoughts on where that focus has come from?
Well, it's quite understandable, really, when you look at the Royal Commission into the financial services industry and how society and members of society were quite negatively impacted by some of those behaviours. And I can really understand why the regulators are quite interested. Investors have been hurt with the fines. There have been some horrendous fines for some of the major banks in Australia around these poor management of non-financial risks, which have actually come out as financial because of the magnitude of the fines. And I think regulators have an interest in getting some type of consistency around the disclosure of non-financial risk and the measurement of non-financial risk. And at the moment, it's a real challenge for companies because there's an environment out there with many organisations coming up with different standards, with different approaches to assessing and disclosing non-financial risk, that there is a role for regulators to be involved, to come up with something that is sensible for all stakeholders, for a listed company when it comes to identifying, disclosing and measuring these risks.
Finally, Pru, do you have some thoughts on your advice to the board and I guess around the governance arrangements in relation to addressing non-financial risk?
It's very important for the board to be informed on these issues. Now, that's not to say that every board should have a cyber risk expert on the board or a climate change expert on the board, because often these subject matter experts don't necessarily make good directors, and good directors need to have an inquiring mind. But it is incumbent upon board members to make sure that they are informed on these issues independently from management, so that they can ask management challenging questions and have a good constructive discussion with management around how these risks are being managed. If the board just sits there and relies on all the information to come from management and doesn't challenge management on how these risks are being managed, there is a risk in itself that they're not being managed, and that's going to have poor outcomes for all stakeholders.
Excellent. And thank you very much for your time today.